What if the biggest reason major projects fail isn't a bad idea or a lack of cash, but something much simpler? A breakdown in communication. I'm talking about the language barrier between the folks who plan the time and the folks who manage the money. Because in project controls, that old saying, time is money, isn't just a cliche. It's a cold, hard mathematical reality. The success or failure of these massive projects literally hangs on this one connection. When your schedule and your cost sheet are truly, deeply integrated, they create this incredible, real-time 360-degree view of your project's health. It means you can spot problems before they turn into catastrophes, and it ensures every single minute of delay has a clear, quantifiable dollar value attached to it.
So, here's our game plan. We are going to build that bridge between time and money, step by step. We'll start with the absolute bedrock foundation. Then we'll pave it with financial data, stress test it for risks, install some real-time monitoring, and finally, learn how to steer through the inevitable storms that come with any project.
Okay, first up, the single most critical piece of this whole puzzle, the Work Breakdown Structure, or WBS. You got to think of this as the project's DNA. It is the unique genetic code that defines every single component, making sure nothing gets missed. So what is a WBS, really? Well, it's basically a top-down hierarchical map of your entire project. It takes the biggest, most complex deliverables and breaks them down into smaller and then even smaller, more manageable pieces, all the way down to the individual tasks. This is how you make sure every part of the project can be planned, scheduled, resourced, and, most importantly, tracked. Now, here's the magic. When the scheduling team, the cost team, and the engineering team all use the exact same WBS, they are literally forced to speak the same language. There are no gaps, no misunderstandings, no lost in translation moments. Every activity on the timeline maps perfectly to a line item in the budget. And let me be clear, this alignment isn't a nice-to-have. It is the absolute non-negotiable bedrock of integrated project controls. All right, with that rock-solid foundation poured, now we can start to build. We're about to go from a simple, static plan to a living, breathing financial forecast. Let's get into how that's done. You see, a schedule by itself is just a timeline, right? It tells you what happens and when. But when we cost load it, we're basically giving it a pulse. We're connecting it directly to the project's financial nervous system. It stops being a flat Gantt chart and becomes this powerful tool that tells us not just when the work gets done, but when the money actually flows. The process kicks off with something called budget recasting. You take that one big capital estimate, that one giant pot of money, and you carefully assign pieces of it to all the specific activities in our WBS. This lets us do accurate time-phased reporting, which gives us a crystal clear cash flow strategy. We now know month by month exactly how much cash we're going to need and precisely when we're going to need it. So, what about the things we can't control? The unexpected delays, market swings, all those curveballs? Well, this next layer of integration is all about trying to peer into the future and putting a price tag on that uncertainty. We do this with a really powerful technique called an Integrated Quantitative Risk Assessment, or iQRA. Honestly, the best way to think about it is like a financial weather forecast for your project. It uses these sophisticated simulations to run thousands of what-if scenarios, showing you how a storm in one area, like a permit delay, could cause a major flood in another, like a surge in material costs.
And the output of this is what's so cool. The iQRA doesn't just spit out one single number. Instead, it gives you a whole range of possible outcomes, which you can see here in this curve. It's brilliant because it acknowledges that there are many possible futures for the project, and it helps stakeholders really understand the risk exposure so they can figure out the right size for their contingency fund, their rainy day fund. And that abstract process leads to some very real, very tangible results. For example, after running an iQRA, a team might be able to say with confidence that for a project in the feasibility stage, they have a plus or minus 10% accuracy range. That's the kind of number that gives leadership the confidence they need to make a multi-million-dollar investment decision.
Okay, so we've poured the foundation, we've created a forecast, and we've quantified our risks. Now, the real work begins. The project is underway, the clock is ticking, and money is being spent. So how do we know if we're actually on track? This is where the full unleashed power of integration really comes to life.
We do this through a system called Earned Value Management, or EVM. Think of it as the ultimate high-tech dashboard for your project. It takes all that integrated data, the scope, the schedule, the cost, and it distills it all down into a few simple but incredibly powerful numbers that tell you everything you need to know, pretty much at a glance.
The two most vital KPIs here are the SPI and the CPI. The Schedule Performance Index, or SPI, basically answers the question, are we on time? A score of 1 is perfect, below 1, you're late. Then you've got the Cost Performance Index, or CPI, which does the same thing for the budget. A score of 1 means you're right on the money. Below 1, you're overspending. Are we on time? Are we on budget? These two numbers tell the whole story.
But these numbers aren't just for looking in the rearview mirror. They are the engine for accurate forecasting. By combining our actual costs with the performance trends we're seeing from SPI and CPI, we can calculate the estimate at completion, or EAC. This is a data-driven, realistic forecast of the project's final cost. It gives you the power to make course corrections before it's too late.
So what happens when things go wrong? Because let's be honest, on big projects they always do. So let's look at how this whole integrated system is used to manage the financial ripple effects of those inevitable changes and delays.
When a critical activity on the schedule slips, it's like dropping a pebble into a pond. The ripples spread out, and they don't just stay in the schedule, they trigger a very structured financial response. A potential deviation notice gets raised, which sends an alert to the entire team to assess the financial fallout, forcing everyone to reevaluate all the time-sensitive costs.
A perfect example of this is escalation. This is just a budget provision, money set aside for the expected increase in the cost of stuff like labor and materials over time. So if your project gets delayed by 6 months, you're now buying those resources 6 months later, probably at a higher price. Your escalation allowance has to be recalculated and adjusted to reflect that new timeline.
Ultimately, this deep integration is about so much more than just tracking numbers on a spreadsheet. It's about turning data into wisdom. It's about gaining the foresight to see around corners, the accuracy to navigate tight budgets, and the transparency to build trust with everyone involved. It's the difference between just hoping for success and actually engineering it.
So the final question I'll leave you with is this. When you look at your own projects, is that foundational DNA, that common language we talked about, is it just a suggestion or is it the law? Is it strong enough to build an unbreakable bridge connecting every single minute to every single dollar? Because in the high-stakes world of project controls, that connection, well, it isn't just everything, it's the only thing.